All right. Good morning, everybody. Closer and closer to the holiday. Very likely won't be here Friday. So this will be the last morning briefing of the week. If you are going to be here Friday, just be careful, watch the clock. So we're going to get more jobs data today. Remember, it's one of the two pieces of the Fed's dual mandate. We haven't had forward guidance in a long time, so these market fluctuations of we're going to get a cut. No, we're not. Maybe we're going to, yeah, no, maybe. That's been the reason for all the shenanigans, the up and downs. At the moment, we're still sitting at a high probability of a rate cut. You don't have to take anybody's word for that. You can always just check it yourself. It's one of the things that I really try to stress to people in the morning briefing is that there are plenty of people who say that they are traders and they have no idea what they're doing. They can't do anything for themselves. They don't have any links to go to, no websites, no resources, no clue. They're just sitting there with their hand out asking for somebody to give them another trade. You're not a trader. You're a monkey pushing a button. You want to figure it out how to do it for yourself? Show up and watch the morning briefing. That'd be a good start. I'll show you something every day. So today, how to figure out what they're doing with the FOMC. Are they pricing in a cut? Are they not pricing in a cut? This is where you go. Now, it says it's unavailable at the moment. Doesn't matter. It's still the place that you'd want to go to. How did I get here? I just went to Google, like we do for everything nowadays, right? Just go to Google and you type in FedWatch. That's it. Type in FedWatch. You'll get to that site. It's from the CME group. There are other places that offer it. I just go to the CME group. The fact that it's down doesn't bother me. It'll be up later. This is where you go. Generally, it'll have the dates across the top so you can see what the current one is and the next one out. And then for the next year, they usually have them grade a little bit, but you can still see where they're at. It's not like you got to sit and stare at these all day long. You just glance at it from time to time through the day, especially if there's been big economic news that may change the market's outlook on whether or not we're going to get an FOMC cut, like today, because of the jobs numbers. So if we look at what's going on around the world, remember the markets are open 23 hours a day and the day is half done. Sleepyhead, you slept through most of it, or at least half of it. So opens in Asia, goes through into Europe's open, and then our open. By the time we get up, then Asia's closed and Europe's half done. So we want to see what that trend was as it cycled around the world. If we were bullish going into the close, it often bleeds over into the Asian open, but the reverse can be true too. If we were sideways and not really doing anything and Asia went bullish, it can bleed over into Europe and then it can leach into our day. So we want to try to get a feel for what the heck happened last night. Anything good, anything bad? Are they worried about something? Are they sitting out? Was they closed for any holidays? Now, that one was always a little tricky to me when I was new because, typical American, I tend to think the entire world revolves around what we do here, and I don't really pay attention to what other nations or other holidays are. But if you're going to be a trader, you got to kind of figure out what is going on around the world. And that means keeping track of other markets around the world. Did they even open today? Are they on holiday? Are they going to be closed all week? You need to know that. And I can barely keep track of US holidays, really. I tell you, just anniversaries and birthdays keep me busy, right? Let alone national holidays. So no way am I going to remember some other country's holiday. Barely get our own. There's a great website called tradinghours.com. It's free. It doesn't cost you anything. You don't have to have an account. You can go there and you can look at any nation around the world One, it'll tell you, is it open right now or not? Two, you can see, is it supposed to be open right now or not? And if it's not, why is it not? So you can type the name that you want across the top. You got a little search feature, or you can just poke around at the different markets that it offers, however you want to do it, and look to see what nations are open, which ones are closed, when they closed, why they closed, when they're going to open again. Try to figure out, again, what the hell happened last night. That also cycles back into economic events. Typical American, right? Pay attention to my events. I don't really care about any other nation's unemployment or central bank status, but we need to. Not all of these sites offer the same info. Market Watch does a relatively decent job of highlighting the big things in the US, but only the big things and only the US. So if you just want to glance to see, is there any really big economic stuff today for the US? This is your go-to spot. If it's not a big thing and it's not in the US, it won't be here. So it removes a lot of the clutter. It's kind of nice when you're in a hurry and you just want to see the big deal. But FX Street has a comprehensive list of economic events around the world. It doesn't have it all. There's a reason that I go to multiple calendars in the morning. We could go to 10 of them and we still wouldn't have them all. Serious. There are so many economic events that happen every single day that if you started to correlate all of them, you, one, wouldn't get them all. I promise you won't get them all. And two, you would just be so busy trying to find and correlate and gather all of those, you wouldn't get anything else done. You wouldn't get any trading done. Governments are stupid and lazy. Promise you they are. They're as bad as big money or, quote, smart money. They will do things on the half hour and they will do things on the new hour. Sometimes they'll do it on the quarter hour, but most of the time, half hours and new hours. That's why we get those little bumps in volume and we see changes in market dynamics and market structure and options flow and plain old flow. Half hour and new hour. It's why I say watch the clock. Because if something's going to happen to change market structure and dynamics and sentiment and anything else, it's likely going to come after some sort of an event or news, which is going to happen on a new hour or a half hour. It's the best indicator you got. We all got one and it's free. Watch the clock. You don't like where we're at? We're sitting at the lows. You're looking for it to change. Look for the new half hour. Look for the new hour. See if we're going to get something that changes, like Europe closing. That very often changes what we're doing for the day. If we're down, we start going up. If we're up, we start going down, or at least we stop going up or we stop going down. So today we've got a lot of stuff going on. Got auctions. We're going to get nat gas and crude storage data. On a short week, we'll often see something change with the nat gas and or crude. That's the change that we're seeing today, is that nat gas is supposed to be tomorrow, but we're going to get it today because of the holidays. If the short week happens in the front part of the week, a lot of times you'll see crude go to Thursday instead of nat gas coming to Wednesday. So those are the two that they kind of try to juggle around. 10 years ago, oil would matter a lot more than it does now, but make no mistake about it, oil can move this market. So while we don't expect much out of it, one of the key things that I tend to watch during that is the strategic petroleum reserves and what they're doing with those reserves. I worked in the oil field most of my life, but swinging a hammer in the mud really doesn't equate to keeping track of the oil and Brent and crude and crack. The whole different world. So we got a lot of data, but most of this data likely isn't going to bother us all of that much. Once we get through the last auction at 2 o'clock, we're free and clear, but it's the 7-year. You know, it's like saying you got a favorite pet, or maybe you like one kid better than the other. You're not supposed to say that. We're supposed to treat all these auctions the same, right? But the 7-year, I don't really have a lot of love for the 7-year. I tolerate it, you know, feed it, put clothes on it, send it to school, but it's not one of my favorites. So, yeah, it's there. Keep your eye on it. Get past the 7-year. It's the last thing we have for the day. I wouldn't get too hung up on it, though, right? The beige book, there has been time in the past where the beige book has caused us some issues. It's always possible that it could happen again. That's at 3. Not really expecting anything out of it. I mean, if it happens, fine, but whatever. I wouldn't expect much out of the beige book. So really, by the time we get done with Christine Lagarde at 1 o'clock, we're pretty much done. We just call it good there. That's also when we're going to get nat gas, by the way. So we just kind of wrap it all up together. The rig count doesn't change much. You know, if they stack a bunch of rigs in the dirt suddenly, then yeah, we're going to see that number change, but that would freak everybody out. And why would they be stacking rigs suddenly? So there's no reason to see that number fluctuate largely. Most of the time when I see that number move in a big way, it's because they've rolled out some big change and they have to lay a bunch down to make these changes, right? Like they started introducing these flex rigs that could walk from drill hole to drill hole when you've got a pad with like 12 or 15 wells on it. And then they had to change out a bunch of the leg cylinders because they were having blowouts. It's kind of like getting a recall on a car. So they stack a bunch of rigs and fix them, and that changes the number. But otherwise, that number doesn't change much. This green line is CTA positioning. Now, the easiest way to understand this chart is just how much are they allocated long. And while technically that's not what we're looking at, if you think of it that way, it's the easiest way to keep track of what we're doing here, right? So are they long? Well, we're above 0, so yes. And are they adding back in? The line is going up, so yes. But it's not like they're extreme about it, right? They certainly liquidated at a higher rate than they're now getting back in. And for all we know, this is just a little bump to the upside before the next leg lower. Still, it stands out. We've made a little move to the upside. It matches the market's move to the upside. So CTAs are adding in a little bit. That was for the SPX. But as you can see, we can pick and choose. You know, we got all sorts of charts to choose from. Gold, for an example, is not back at these previous extremes, but they are not down at these lows either. So they're kind of in the middle. If we were judging this on a gauge of how much long allocation or how much exposure they have to gold, they're not at extreme exposure, but they're not at their lowest levels. That's a comfortable medium right there. And if you look back at all the times they liquidated, this so-called smart money has a great habit of dumping it right before it makes big moves to the upside. Like here, for an example, where they dumped it and gold just broke out and ran like a mad demon, left them scrambling. Smart money, my eye. Aggregate short flow across non-profitable tech names has increased for 5 straight sessions. Wow. Non-profitable tech names. I wonder how they're defining non-profitable. Because if you take a company that typically is profitable and then they're spending so much money that they are no longer profitable this quarter, is it going to be counted as one of those quote non-profitable tech names? A lot to be desired in figuring out what they classify there. Did you notice Kathy Wood was shopping around? I know she's easy to poke fun at, but she's got a target on her back, and I think people like to poke fun at her. So JP Morgan doubled down on their bullish outlook. Every time they do that, though, it makes me think of the sold to you sort of concept. I'm not a big fan of following the bobbing heads, but there is that. The news from Google yesterday that knocked Nvidia sideways. Nvidia recovered relatively easy. And HP certainly does fit in that space of non-profitable tech. The VIX got back below that $20 level that we've been talking about. The gamma flip point is 6,700 in the SPX, not the ES. Oh, no, too much. All right, we are about right here. 67.52 SPX is where we went into the close. If we drop back down below 67.52, then we're going to have this speed bump over our head that we've got to get through. But even if we do get through it, we've got this very large beast at 6,800. There's a phrase from Volland. This isn't Volland, but there's a phrase from Volland that says climbing uphill is more difficult than going downhill. And it's a simple concept, right? All things considered. That if we're going to climb this mountain, it is more difficult, right? Water flows downhill. It takes the path of least resistance. I've often said that nature and the markets are a lot alike. So moving downhill from 6750 is certainly easier than moving uphill. And we don't have to. And we can stay above this speed bump because we are on the right side of it. And we could just stay in this zone, especially for the rest of the week, certainly for the rest of the day. That 6,800 is a significant level, right? If we get on the other side of that, however, moving higher from there would be easier because we're headed downhill, right? We're headed to downward slope from here. We just got to get past it. So maybe one of the headlines that we get today is going to give us that fuel to get past this 6,800 level. Maybe. I don't know. My magic 8 ball hasn't showed up yet, but you know. They actually called John Deere an AI company, huh? I mean, there is a couple of drone companies that are using AI and mapping out fields and that sort of stuff. And there's automatic self-driving tractors and that sort of thing. But it's a stretch to call John Deere an AI company. I mean, a real stretch. I can build paper airplanes. It doesn't mean that I'm an airliner. Did you notice, by the way, the airlines are suddenly talking about one of the most prolific travel holiday season in decades, when last week they were saying that it was one of the lowest travel seasons in decades? Like suddenly everything flipped and now everybody wants to pile on an airplane? Not in the chip sense. I wonder what they mean. AI, but not AI, right? Well, looking at the trailing net flow of buying, that's been a significant level of buying. 1 to like 1.5 would be closer to the norm, and they topped out higher than 2.5 over a 2-day period. I get it. There's a lot of people right now saying, why are we so bearish? Everybody's so bearish and it just keeps going up. I'm not bearish, but you got to admit there's a lot of bricks in the wall of worry, right? But I've been arguing that there's been bricks in that wall of worry all year, and we just kept on going up since April, right? It's been like that. Seemed like all year it's been like that. And my argument didn't change on this fall back here either. 65.50 is what I was talking about when we were at 69.50, and we did that. We're done with that. And right now we're working our way back up. That's a good one. I might steal that, but if I do, I'll give you credit. All attribution to you. All right, so as we do every day, we want to take a look at the daily and have a little bit of a discussion about what we're looking at way back here. Now, I know it's a little ugly, and if I removed the indicators and I put it into a line chart, it probably wouldn't be so ugly, right? I remember when I was new and somebody sent me a picture of a line chart, and I kind of scoffed at him and said, what do I need with that trash? Right? Because everybody I knew was talking about candle patterns and all these various signals that you could get from candles. Why would you send me a stupid line chart? Well, because sometimes a line chart just really clears things up. We're looking for the old school, very simple concept of price action. And as you can see here, when I turn it into a line chart and remove all of the moving averages, we've got our lower high, we've got our lower low. That's 1 and 1. We need 2 and 2. This, while I did mark it, doesn't count as a lower high or a lower low because it wasn't a lower low, right? So we've got 1 of each. We need 2 of each to have a full set. A full set would be a downtrend. It's just straight up what we would call it. But to get there, we would also inevitably end up below the 10-week, which would also be a downtrend. So if you use moving averages, once we are under the 10, you can say we're in a downtrend. Or you can look at how price got below the 10, and then you could say the same thing. Yeah, we're in a downtrend. Sometimes, though, we just get one straight shot to the downside like we did back here, in which case you get below a moving average really fast in a single day where it didn't trend down there at all, in which case, you end up mean reverting like a liquidity gap, which is what we did. We ran back up, closed the gap, rejected off of it, and then expanded beyond it. So we've got this lower high, and right now we've started this next run up, but it's not yet at this high. One, we need to know, is it even going to reach that high? Two, matching the high won't count. It has to get above. So how we leave this run is going to be really important, and we can't count it for today, right? Because today is still alive. For all we know, we could run up there today. But on the other side of that, if we fall away from here, we would have to cut below this low and close somewhere down here for us to look back and say, oh, wow, look, another lower high. So we can't count this candle as anything. It's not a lower high. It's not a higher high. It's nothing at this point. And when we look left, we are inside of this really big range. Now, if it was a simple TRB setup, like if we was to go to a weekly, we can see that it's a really nice TRB. That would be different. Then we would be in a part of a range. I think the Russell had a better one, actually. I was looking at the Russell. Yeah. That's a really nice TRB setting up on the Russell. We got a Morningstar reversal, big explosive bar. This one bar could run all the way to the top in one shot. Beautiful TRB setup. 3-bar reversal, the whole thing. This is awesome. That's the only time that when we are in a range that I look at it and think, yeah, there's probably got some opportunity there, is when we have a really nice setup that goes with it. Otherwise, price in a range is just that. It's just price in a range. And if it's choppy, sloppy, ugly, trash, then it's sloppy, ugly, trash. You have to learn at some point that if there's nothing there, you just accept the fact that there's nothing there. And a lot of new traders haven't figured that out yet. They seem to think that, well, if you just look hard enough, you'll be able to dig out the answers. Maybe I just haven't reached that point yet. But if it's trash, I leave it the hell alone. We need to know how this resolves. Are we going to get a lower high, an equal high, or a higher high? And until we have that answer, we're just still in a range. And we got to get that worked out. Today, we made it back to the top of this bar. Now, granted, we made it there last night too. We hit it last night. We are above it today. It is a cog line, 6792 cog, and we need to keep it. If we don't close above it, it's not that bad. Because if we close near it or at it or on it, it's fine. Just like yesterday, we closed near it, at it, on it, it's fine. But if we fall away from this, and then we say we cut yesterday's mid by 50%, that's game on to the downside. And if I was using OCR style analysis, we can run these up. So what happens after a swing low? We get wicks on the bottom. Wick on the bottom, wick on the bottom. Hey, no wick on the bottom. We're going to have to see how this resolves. And it's the top of the box because all of these are IX10. So if we're going to reverse, we cut 50%, 6732 cog line. Once that breaks, it's game on to the downside, and we can run that popcorn stop trigger play in the opposite direction all the way back down. Get below that level, we trigger. Get below that level, we trigger, and it gets us back down into 6550, level by level by level. And all we have to do to start it all off is cut below 6750 and get underneath this cog line. Otherwise, if we close outside of this bar, it's more likely that we stay above that bar and that we continue to work our way up. It's not a guarantee, right? Nobody knows what the heck price is going to do. But it's more likely if we close outside the bar that we keep it outside the bar. And the farther away we are from that line when we close, the better. So if we close really close to it, we could fall back down underneath it again. They rolled the call wall down last night, right on our heads. Now, to be fair, yesterday when they were doing those rolls, it wasn't, right? We were in the 67.80 area and they rolled it down into the 68.20 area. So it wasn't right on our heads, but kind of felt that way. So we've got an options level that we're hitting here, 68.11 cog line, and above that, 68.16 call wall. The call wall by itself is just a spot where we expect to see them sell calls or monetize their calls. It doesn't have to make price go down just because they do that. And when they quote sell those calls, they could just roll them. Sure, the function is the same, right? They're closing those calls, but it would just be that they're moving their position to a new location, not exiting their position. You can see we've started to turn the corner since last night with the lower highs and the lower lows, which is really a nice description of what I was talking about out there on the daily. We cut this low with a new low, so that's 1. There's our lower high, and that's 1. New lower low, that's 2. We need to see how this resolves to see if it's going to be number 2. That would be a full set to the downside, 2 lower highs and 2 lower lows. But we don't have the lower high yet. We have to resolve this particular candle right here. It's not even a zipper play either, because if you notice, all the weight is on the downside of the VWAP. If we do get above the VWAP this morning, look for reciprocation measurements. Whatever we got on the bottom side of VWAP, look to get that on the top side of VWAP. And what's that hit? The call wall. You couldn't make that up if you wanted to. $84,000 in the overnight. It's not bad. It's a little extra volume. It's an interesting amount of volume on a holiday week in this period of the year, right? You know, we have like the summer doldrums and we end up with some lighter volume. And then we have the holiday schedules where we also generally end up with lighter volume. This is not lighter volume. This is more than 50% of the average volume that we typically get. So, yeah, they're coming in a little heavy, and it's to the downside. We can see that the trend was clearly headed lower after peaking out last night. We hit the cog line, 68.11, and that was the LIS. That's the line in the sand. So Volland acronym. There's so many acronyms nowadays. All right, they are hedging this morning. Don't get me wrong, they're always hedged. Always, always hedged. This is additional hedging. Kind of like you hear there's a hurricane coming at you and you call your insurance company and say, I would like to get additional hurricane insurance just for today. I don't need it tomorrow. And you pony up a little bit extra because you know something's coming. Well, that's exactly what they're doing here. Something's coming. And we started this briefing by looking at the economic schedule. And sure, there's some unemployment data there. Does that warrant additional hedging this morning? Or is it something else? So we can make the assumption that it's the 8:30 data that they're worried about, but you're going to want to keep your eye on the market maker move to see if it starts to go down after 8:30. If it doesn't, then it wasn't the 8:30 data. Of course, we've got 10 o'clock data, 10:30 data. We've even got afternoon data with the auctions. If you don't have Thinkorswim and you don't have the market maker move, as long as you've got options, then you can see the market maker move for yourself. By the way, on Thinkorswim, it's right up here. if there is a market maker move on the product that you're looking at, it will show you right there. If there's not, there won't be an MMM at all, which I've sent them emails about that. They should at least leave the 3 M's there. And then if there isn't a market maker move, just put 0 there, right? I've had people say, how do I turn it on? You don't. It turns on by itself if there is a market maker move. But if you're not on Thinkorswim and you want to see if there's a market maker move, what it is doing is it's looking at the front expiring option, right? So this is the 0-day option, and this is the implied vol average, which is 11.55. If that number is greater than the next expiration out, you've got a market maker move. That's how it works, right? How do we know that they're hedging? Well, the trading activity required to jack up the implied volatility average is significant. So this number, while it is proprietary and they don't tell us exactly how they calculate it, has some publicly known concepts. One, it uses the square root of time. That's a fun math formula for you, by the way. So it looks at how many days to expiration. And then it uses out of the money options on the call side and the put side. So if we get out of the money options trades on the call side or the put side, it can adjust this. But what also changes it is the frequency of those trades and the size of those trades and how those trades are hitting at the ask, at the bid, split at the mid, as a spread, individually and singly. So all of those are contributing factors for changing the implied vol average. And every single strike has an implied vol. They aggregate all of that implied vol into this average here. So what happens? They get nervous about something. They come in and they start trading a lot of these out of the money options, developing hedges that are just for today. And it jacks the implied vol average up in the front end, makes it higher than the next expiration out. That triggers a market maker move, and it tells us that they're hedging. So when I'm telling you that they're hedging this morning, it's not my opinion. I'm not guessing or assuming or making assumptions. I'm just straight up telling you they're hedging this morning. And when they start to unwind that hedge, we will see it because that number will start to decrease, and then eventually it'll go under the previous level and you won't see a market maker move anymore. We got an inside day breakout and we were not able to keep it by itself. That's generally not good. So we got our 111 there. It's yesterday's 111, one of my favorite trades. Hopefully we get another opportunity to participate in that. If not, well, whatever. So we are at the moment still outside of yesterday's range, but we cut back in once. That's not good. It really isn't. So we need to stay with this inside day breakout. We need to keep it. Getting back in after an inside day breakout is not good. And it's rare to get an inside day breakout and then give it up and then break back out again and keep it. So while I don't want to say that we can't do that, it's very rare to do that. If we get back inside of yesterday's range, we're very likely going to stay inside of yesterday's range or go all the way down and break out of the other side of yesterday's range. That's the way it works. A 111 of yesterday's range. It doesn't really matter if you were on a 15-minute, a 5-minute, a 65-minute. You put it on yesterday's range and you project a breakout of yesterday's range by looking at the 111 and the 1236. It doesn't matter that it's a 15-minute chart. It just matters that you drew the range on yesterday's level. Yep. We got close to the upper ADR 6832 cog line, but we didn't hit it. And there's a little tell in there. We should have hit it. If we were going to go up there and do it, we should have done the thing. The fact that we stalled out and failed to even get there calls into question whether or not we're actually going to go there. Now that we're pulling away, if we break our own Globex low, then we will target the lower ADR. And if we break our own Globex high, then we will target this upper ADR. That's pretty simple by itself. Now, me, I don't like shorting from the hole and I don't like buying from the highs. So, you know, all things considered, I'd rather try to get long on the low here and see if I can make it back to the top, kind of like a TRB setup. Or I'd like to short off of this high and try to make it back down to the low, which would be just a continuation of this wave to the downside. But I'm already done trading this morning. And if I get any trading done, it'll be after 11 o'clock today. So it'll have to work itself out. We do have the opportunity for a liquidity gap this morning. I've done videos on the liquidity gap before. The main idea is that at 8:30, we could get a really big bar. And that really big bar is the gap that we want to focus on. It's not a gap in price. It's a gap in liquidity. So at 8:30, we're going to get data. And these gaps can happen anywhere, these big bars that I'm talking about. So we could get one at 10 or 10:30 or 11 o'clock, you know, wherever. We want to see one of these big bars, kind of like this. This was a big bar. And this is the gap. Right there that it needed to close because that's where it opened. You could even argue that the event actually started here and that was the gap. And what did price do? It ran back up to close the gap and then immediately fell back away again. Now these liquidity gaps at 8:30, it's a little bit different because they're known events, they're known situations that are coming. So if we get an 8:30 liquidity gap bar, I will post it in the chat and say that that's what it is. Once you get one of these bars, you can measure it. You can use it for expected move models, market's midpoint, and have the expectation that we can go back to where the candle started, which means going back to the 8:30 open. We have to get there though first. And if we don't get one at 8:30, then we have all the other economic events for the day. We could get one at one of those places. We don't have a MDP from yesterday. It's a missed daily pivot because, well, we hit it yesterday. So we had one on the reversal day that we talked about. It's really nice. But we lost our count yesterday because we hit it. And now here we are again this morning with a new missed daily pivot. But it won't count today. We have to go all day without hitting it like we did on Monday, where we went all day without hitting that floor pivot. For the moment, today's floor pivot is higher than yesterday. That's bullish. Price opened above it, and that's also bullish. But we've got a greater than 70% chance that we're going to come inside this channel and hit that line, 67.50, because markets like to hit their floor pivot. That's just what they do. So it's not guaranteed. It doesn't have to do it. Here's a great example for Monday where we didn't do it. But generally speaking, markets want to hit their pivot. So if we break this Globex low, 67.50 is on the table as the floor pivot that we want to hit. The R1 is 68.25, and we didn't get there. We got close. The thing about these S&R lines is they're a lot like the ADR lines. So we could just stay inside of it all day today and not do a darn thing. We could just do that right there. Just stay inside the zone. The indicator is projecting upside movement. How do we know this? This is R1. This is S1. This is the floor pivot. All right. So with that in mind, the indicator is showing that the green box or the green line down here is closer than that red line is up there. They're both ones. That's R1, that's S1. All things being equal, if the market wasn't sure we were going to go up or down, it would draw those two lines equally distant from the floor pivot, but it didn't. The red line is so much farther away than the green one is because it's giving us projections to the upside. Now look, this floor pivot doesn't make price do anything. It won't make us go up or make us go down or stop us from going up or stop us from going down. It's just math. Even where those levels get drawn is nothing more than math. But the math comes from the previous day's price action, and the indicator is projecting that up is more likely than down. That's the way it works. So does that mean we're going up? No. Price can do whatever the heck it wants, and this indicator won't make it do anything. If we get through our own Globex high, that is the target. If we can get above it and close above that line, it opens the next level and we can get an R2. Kind of like back here where we ran up and we got above R1 and we kept it. We started working on R2. Now we didn't get to R2, but we tried, right? Same thing here. We got above the R1, we kept it, so we tried to get to R2. It's rare, but if you drop back down below R1, that's supposed to be an indication that you're headed back to the floor pivot. But as you can see, it can turn around and TRB and run back to the top of the range and break out and even keep going higher. That's why power hour is shenanigan time, right? Get all kinds of silly stuff happening. Yeah, the market maker move, that's a good question. This used to be owned by TD Ameritrade, and they had, oh man, like 18, 20 articles on market maker move. But now that Schwab owned them, they consolidated all of that into like one article, maybe two. So if you was to Google market maker move, you'll find the article written by Schwab that talks about that market maker move. The problem is they only really talk about it in the context of equities and events like earnings. And they don't make any connection whatsoever to the fact that futures have options and that we can use it the way that I'm using it. I had to figure that out for myself because, well, I tend to just, make my own tools. But at the very least, you would learn, what they're doing and why they made the market maker move and some good insight into options and all that good stuff. So it's worth Googling it, checking it out. If you know how to use the internet go back or way back, you can go back and check Schwab's old articles. So we're still above that pivot that we've been focused on the week. We got back up to this crazy pivot point from last week, which was an awesome liquidity gap, by the way. And you can see how price responded to it when we got back up there, how we tagged it and immediately fell away because we closed the gap. But now we're above it, yay, and we need to keep it. So we fell back into it. We're testing it. We really need to hold the line there, but we're setting lower highs and lower lows, and maybe we don't. So if it breaks, the point of control is what we want to focus on. Getting inside this value area again and getting back down to the volume of the week, which is around that 67.20 zone. Notice we ran out of buyers. We didn't run into sellers. It's kind of a big difference, all things considered. If we'd have run into a lot of sellers, that would have been a completely different look to the profile. But this is a weekly, so we're gonna go down to the smaller time frame and check it out. But it's just worth noting. Also, we got an awesome little speed bump here, 67.74. I mean, that's kind of cool, really. That wasn't me, by the way. I didn't do that. I got an idea who did. You know who you are. 10-day, 30-minute volume profile and TPO. The TPO is on the right. Volume profile is green. It's on the left. We're outside of the value area and we're above the point of control. This is a real sloppy, ugly mess, by the way. But you can see the speed bump overhead, 68.75. If we continue this drive to the upside, we're going to hit our head on it. But every day that goes by, we're taking more of that liquidity off the table. If we can make it through the week without expanding any higher than we are right now, then we'll tighten up our range considerably and we'll have this 300-point range next week. It's been a while since we've been so narrow. But to do that, we can't get any higher than this 68.11 cog line that we've already got. Now, we've had some bullish moves in the last few days. It's obvious, right? From right here, right? The reversal off of Friday's low, Monday, Tuesday, Wednesday. It's just been up and to the right. Most of that run was just getting us back up to Thursday night, Friday morning dump. That's all it was, right? A one-day dump and 3 days to make our way back up. So what's the old phrase? Jumped out the window on the way down, but took the stairs back up. So here we are. Now we're getting that overshoot, a little bit of a 111 or a 1236. And we're not even quite there yet. It would depend on how you drew it. If I pulled that up to 65.50, which is how I would have done it if we were on the intraday in the normal chart area, 68.17. If we're going to reverse on a breakout, price almost always does that on a 111. If we're going to fail a breakout, 111 is very often where that failure comes in. Of course, not even getting to the 111 is failure too, but just saying. So this, quote, bullish run that had everybody all twisted up in knots because they felt like they got left behind. You got room. We're not back to the top, right? If you don't like the trade that's out there, take the other side. Tom Sosnoff always said. So if you're still bullish, well, you got time. Everything that I've pointed out today says we still don't know what this high is going to be yet. We have a new VPOC. So a break to the downside if we happen to get through our own Globex low and we get back inside of yesterday's value area. We got a speed bump here at 68. So that's 67, 68. High volume node. Then we're inside of the zone and we can focus on 67.20. I don't have that set to the tick. You do you. If you want to zoom in and try to get it just exactly perfectly on the line, you could probably run 67.19 and get a little closer, but I don't get it to the tick. To the point is close enough, right? Because we all just want to get to the point. So level by level, break our own Globex low, get through this rough patch, this high volume node. It gets really shallow, so we should move through that area easily like we did yesterday. And then back into the VPOC 67.19. We were going to look at the volume on how we ended yesterday. On the higher time frame, it looked like we didn't run into any sellers. It just looked like buyers got exhausted. But you can see how we ran into sellers on this time frame. So yeah, we did run into sellers. We just couldn't see it on that higher time frame profile. And we are outside of the weekly expected move. This is our expected range for the week. We've exceeded that range and we are continuing to press to the upside. There's a 70% chance that we will close the week inside this box because it's a 1 standard deviation box, and that's what price does. 68 point blah, blah, blah. We just round up and say, 70%. So, if we close outside the box 1, 2, 3 weeks out of 10, then we're doing our 70%. But if we get close after close after close outside the box, it's a big red flag and warning that the markets aren't adequately pricing in the volatility that we're getting in a day-to-day basis. So the easiest way to do that is just to count back 10 weeks. You don't have to count every single week on the screen. That'd just be crazy, right? 10 makes a nice round number to do percentages. So if you count back 10 weeks, how many weeks closed outside the box? That one did. That's 1 week. This week doesn't count because the week isn't done. This one was okay. That one was on the line. This was okay. Okay. That one failed. And that one failed. And that's okay. And that's okay. And this was a new week, a new contract. So that was broke. So 1, 2, 3, 4. We are already too many, right? Out of 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 would be back here because we would not count that broken one. And that was also another one that broke out, right? So that's 5 out of 10, 50% of the time. That is a huge red flag, right? That we are exceeding expected range move models, that we're blowing out the options expected move ranges, which we already knew that because look at the big old candles that we're getting on a day-to-day and a week-to-week basis. This tells you that if you're trying to sell premium for a living, you're going to get your butt handed to you. You're not getting paid for the risk that you're taking. It's not worth trying to do that. Now, if you can sell premium the way I do, and then you reduce that risk significantly, and then you can make it worth your while because you also get paid a heck of a lot better when you do it the way that I do it. But if you're using the same old YouTube guru 12 delta out of the money trash, you're gonna wish you hadn't done that. So don't sell premium in this environment unless you tighten it up and run my model. The expectation of closing inside the box is still there. We expect to close inside this box, but we're not doing a good job with that. And we have failed 50% of the time recently. And I don't know, 50%, it doesn't inspire me, right? That's a coin toss, yo. You can do better with Vegas odds than that. We are 1% above the 10-day. That's getting right to the edge of what normal is. Once we begin to expand beyond 1% to the upside, we start asking questions. Did we move too far, too fast? Is it ready for some sort of pullback or mean reversion? A Z-score would be much better to answer the question on mean reversion on a granular level. But at this point, looking at this, no, we're not there yet. We're near the edges of where we need to start getting concerned, but 1% above the 10-day does not equate to a need to mean revert. It doesn't owe us a mean reversion at this point. We're not overbought. We're not overextended. We have not moved too far too fast, and it does not owe us a pullback. To tighten that answer up, though, you would really want to look at a Z-score. Now on the week, not even close. We are more than 1 1/4 above the 10-week. And that is nowhere near overbought, overextended, or having moved too far, too fast. And we're still working on these lower highs. So we haven't broke that system yet, which means I'm not overly bullish because I'm not getting my new highs here yet. But we're back above the 10-week. And that, again, means that I'm not bearish either. That's why I run a beta-weighted portfolio, so I don't have to be bullish or bearish. So keep your eye on the 10-day today and whether or not we stay above it or drop back down through it, or even just come back down and sit on it. The VIX is down, and so is Bitcoin. China's down a little, but it doesn't count. It needs to be down like 0.5%, and it's not even there. And this down that we're seeing is not because we were up too far. We were barely up at all. So don't know what's up with China yet, but that's not enough to be concerned about. Bitcoin is down near 1%, but it was up 3.5% in a 5-day period. But yeah, it's Bitcoin. That's really not much when you're looking at that market. Looking at what's up this morning, gold miners, Mag 7, uranium, chips, tech, mags again. So, I mean, all of that looks good. We've got bullish momentum all over the place. And it's not up too much. You know, I don't like it when chips are up like 6% in the pre-market because it doesn't really leave much for us, right? But they're not up 6%. They're not even up, 0.75%. So it leaves us plenty of room. We could get a rally day with these sectors. Because of these sectors, we could get a rally day. We just need them to follow through and continue the push. So if we were to look for this to broaden out, we'd want to see a stronger connection with the Mag 7, get some of that consumer discretionary, and then specifically things like cloud computing would be good to see, and that expanded tech ETF, that would be a good one to see getting lit up. But we just don't have them this morning, right? Not yet. Gold being up is certainly good. It checks the box. And I would want Bitcoin to turn it around and start moving to the upside too. But again, it doesn't have to, right? That's just icing on the cake to get such things. IGV is the expanded tech that I was talking about. So you got cloud, CLOU, and IGV. We'd want those two to kind of, get in gear and bring it up some. Also, speculative tech stuff would be good. Get that quantum up there, electric vehicle takeoff and landing, those air taxis. More of the SMRs and uranium place would be nice. More speculation, right? But it's a little light at this point. So I'm not overly excited about the possibility of another up day. But we have the start of one so far with those sectors being up. Remember, we're looking for reciprocation on the VWAP, so keep that in mind. We are through the 8:30 data point, and we didn't get a big liquidity bar. So whatever they're hedging for, that wasn't it, right? Or maybe it was, because look at that, it's gone. Well, there you go. That was what they were worried about, and now they're not, because it's gone. Sure is. So we're done with that, which means we could finish this megaphone pattern and TRB back to the top and challenge that 68.32 cog line. Again, if we break Globex low, it's game on. To the downside, we'll look for the mid of yesterday, the lower ADR, and the full ADR to match yesterday's low, and then it's going to start to get real ugly from there. No reason to think we're going to get that today, though, right? We would need some negative news that at this point we just don't have. I really don't think Christine Lagarde's going to say anything this afternoon. That's, they do a really good job of telegraphing. If she had anything of note, we'd already be hearing about it. So pretty easy day, all things considered, right, guys? Get out the box, GTFO. You have to get out of that box to do anything else. Be careful, be safe, have a good weekend. I will see you all on Monday.